We have 2 hours to go through taxation of scientists, university teachers, and students. So it's quite challenging task to explain it within 2 hours, but we will do our best. Basically, today's webinar should have like 3 parts. In the first part, we will focus on some theoretical parts regarding international taxation rules for particular groups. The tax residency, non-residency, who is liable to tax in Slovakia, from what income is taxable, how this income is taxable. Second part, to switch from theory to practice, we will go through some case studies. And there will be like situations, some cases which are based on some real stories. We will go through these cases, and because it's April, of course, what is like hot current topic is it's annual tax compliance for 2025. When the deadline was end of March with the potential extension till end of June or end of September. So in the last part of the webinar, we will go through a tax return, and we will present how to fill in data and how to process this tax return for 2025 here in Slovakia. So let's start. When we are talking about taxes, the relevant sources of data which you should be aware are about personal taxation. The main documents there are 3 documents which you have to follow when you deal with taxes. First document, the most important one in Slovakia for taxation of individuals, is Income Taxes Act, which is Slovak legislation which deals with taxation of individuals. In many cases, when you will not consider only the Slovak legislation, but you have to consider also international taxation, which is superior to the Slovak legislation in some cases, and in many cases, you will have to check bilateral treaties between Slovakia and particular country in which you may be resident or which may be source country of the income. And because bilateral treaties are nice, but they need some explanation how particular provisions in these tax treaties are considered and what is their explanation. There is document which is called OECD Model Tax Treaty, which basically most of tax treaties which are concluded by Slovak Republic follow this model tax treaty of the proposed by OECD. And we will go in particular to Articles 4, 15, and 20. 4 is residency, 15 is employment income, and 20 is a special article for students. Some short note at the beginning. Today we will be talking only about taxes. In many jurisdictions, or quite often, taxes are very much connected to Social Security, and also in Slovakia, if certain income is subject to tax, it is also income to Social Security, health insurance. We will not focus on Social Security. We will mention Social Security in some case studies, but we will focus mainly on taxes, because there are quite different rules quite different international rules. There are differences between taxes and Social Security. So tax regime and Social Security regime may have some different tax and Social Security regime in some situations. First, when we start discussing your tax obligations in Slovakia, the first question which you have to consider is the tax resident is your tax residency. Tax, because based on the tax residency, we the tax treaties and the legislation considers tax residency of corporations, but also tax residency of individuals. And to define whether you are taxable in Slovakia and from what income you are taxable in Slovakia, you have to answer firstly the questions a question whether in Slovakia you are tax resident or tax non-resident. If you conclude that in Slovakia you are tax non-resident, meaning taxpayer with limited tax liability, you will be taxable in Slovakia only on the Slovak source income, which is income. We will go. What is Slovak source income for non-residents? Because it differs depending on what type of income you are receiving. On the other hand, if there is a conclusion that in Slovakia you are tax resident, you will you will be taxable in Slovakia on your worldwide income. So income received from Slovak employer, but also from foreign employers or from trading with foreign capital gains, whatever income you receive and it is taxable income, you have to declare this income in Slovakia in case you are tax resident in Slovakia. To define whether your tax residency position, you have to go first to the Slovak tax legislation, Income Taxes Act. So this is the process how you define your tax residency. So your first question is, am I tax resident based on Slovak tax legislation, local legislation? We will later explain what are conditions for tax residency in Slovakia. But if you check the provisions of Slovak tax law and you say, okay, I meet one of these three conditions, which we will explain in a minute. Yes, the conclusion is yes, I am tax resident in Slovakia. If you are a tax resident in Slovakia, question 2 is whether you are tax resident also based on the local tax legislation of another country. If you are inbound, it's maybe probably your domestic country, your home country. If you are outbound, whether you consider whether you are tax resident in the host country. If you say yes, based on local tax legislation of another country, I am tax resident also in that second country, there is a conflict between two local tax legislation. You are tax resident based on Slovak tax law, you are tax resident based on local legislation of another country. And if there is such conflict between two countries, you have to go to check the bilateral treaty between Slovakia and the other country and conclude what is your tax residency position based on provisions of particular treaty. So when you go in step 1, you consider Slovak legislation, and Slovak legislation defines 3 criteria under which you are regarded as being a tax resident in Slovakia. First, you are tax resident in Slovakia based on local tax law if you have permanent residency in Slovakia. Permanent residency has two different acts which deal with permanent residency. If you are Slovak citizen, you have permanent residency based on Act on Residency Registration, Zákon o hlásení pobytu občanov. If you are foreigner, you can get permanent residency based on Act on Stay of Foreigners, which actually, if you come from EU country and you register with foreign police, you automatically receive permanent residency. If you are coming from non-EU country, you receive temporary residency permit. So if you are from Slovak citizen or if you are from EU country and you requested foreign police for residency permit, you have permanent residency in Slovakia. If you are from non-EU country, you don't have permanent residency in Slovakia. You can request it after 5 years only, or in some special cases like marriage, etc. Second criteria, you are considered to be Slovak resident if you have permanent flat in Slovakia. Permanent flat has its own definition. It's a flat which is anytime available to you, and it is apparent that you tend to reside in this flat. It could be owned, it could be rented, it could be your parents' house in which you have some room which is fully available to you. Anytime when you come to Slovakia, you have free access to this accommodation. This is permanent flat. And second and last criteria, you are considered to be Slovak tax resident if you spend more than 183 days in a calendar year in Slovakia, and including days of your arrival, departure, all these days do count for the calculation of 183 days. So if you meet one of these three conditions, based on Slovak tax law, you are regarded as Slovak tax residents. As we discussed, second step is considering tax residency position in another country. If you conclude, yes, I am tax resident also in my home country or host country, and there arise this conflict of tax residencies, you check the tax treaty, Article 4 of the tax treaty, and basically almost all treaties have the same rules for determination of the tax residency position based on the treaty, which is the final final decision in which country you will be resident or non-resident based on the treaty. There are some very few countries, especially USA or Israel, that have some little bit different conditions, mainly based on citizenship, but most countries which follow OECD rules have this process. First, if there is conflict between tax residencies in Slovakia and another country, you will be regarded as tax resident in a country in which you have permanent home. Permanent home is very similar as permanent flat in Slovak tax law. It means the country in which you have accommodation which is available to you anytime, and you can access this accommodation without any restrictions. This is permanent home or permanent flat. If you have permanent flat in both countries, for example, you are from other country, which in that country you keep house, flat, or you still have some space in your parents' house. You are coming to Slovakia. In Slovakia, you have rented some house. Then you have permanent flat available in both countries. So you go to second criteria, and second criteria is center of vital interest. Center of vital interest. I will. This was permanent flat. Center of vital interest is country to which your personal and economic relations closer. That means in which country does your family live? In which country you have girlfriend, boyfriend, wife, children, where the children visit the school. These are the strong indication of your tax residency. If in some cases there are also there is personal and economical ties. Usually in practice, these personal ties are more relevant, but also economic ties can be relevant, especially if you are single or etc. Also, the economical ties must be considered. Like so, I said the family is like the main feature of for the determination of your tax residency, but also in which country you have cultural, political activities. You have in which country you keep your bank account. As very important is in which country you spend your weekends, your vacation. All this indicates that your ties are closer to that country. So this is usually, I would say 99% of cases is decided on these two criteria, permanent flat and center of vital interest. And it's very often it is about your how you can argue. There are some objective criteria, of course. If you have kids and the kids live with you in Slovakia, or the kids live in other country and you spend every weekend in that country, it's very clear. But if you are single and there is also some space for you to argue, like to consider what is your preference and then to find some arguments supporting your decision. This determination, if you make some decision, you can request a particular country for issuance of the tax residency certificate, and in that certificate you declare first, yes, I meet conditions for tax residency. I will now say about if you request Slovak tax residency certificate. In this request, you declare I meet conditions based on Slovak legislation, meaning spending 183 days, I have permanent residence in Slovakia, I have permanent flat in Slovakia. Then there is question, are you considered tax resident in another country? If you say no, automatically there is no conflict between two countries and the Slovak authorities will issue that you are resident in Slovakia. If you say yes, I am resident in another country, you have to fill in which country you are tax resident, and you fill in next questions where you have permanent flat. Slovakia, another country, or both. If you say in both, still you go to another country, in which country you have center of vital interest. And if you say this is Slovakia, not other country, the Slovak authorities will issue to you Slovak tax residency certificate, confirming that based on data which you provided, you are tax resident based on the Slovak tax law and the tax treaty between Slovakia and particular country. So if you want to have some official document saying that you are tax resident, you can request Slovak authorities, and very similar process is in other countries. For what period you can request or you can determine your tax residency? The Slovak tax law defines only one tax period, which is calendar year. However, there is some guidance issued by the Slovak tax authorities, which says that okay, we accept that the tax residency can be shifted from one country to another, also during a year. So the Slovak authorities, it is not in the law, but the Slovak authorities do accept also such partial residency. Usually it is accepted if you, for example, if you are coming from another country to Slovakia and based on the local tax law of that country, you you deregister for tax purposes in your home country, for example, from UK, from France, from Germany. If you have option, for example, to declare to deregister based on local tax law, and because there is no conflict between two countries anymore, because in the home country you have deregistered, Slovakia accepts okay. For the period after the relocation, even if it is during the year, we accept that we will consider you to be home country tax resident for the first part of the year and Slovak tax resident for the period after the relocation. So when you do this exercise regarding determination of the tax residency, and you come to conclusion that you are tax non-resident in Slovakia, as we defined, tax non-resident is taxable on the Slovak source income only in Slovakia. And what is Slovak source income depends on the type of income which you receive. Most common situation is employment income. If you receive employment income and you are non-resident in Slovakia, Slovakia is entitled to tax this income only if one of these three conditions is met. You spend 183 days in Slovakia, you are remunerated by Slovak employer, or your costs and work are allocated or attributable to Slovak permanent establishment of the foreign entity. So if one of these three conditions is met, then Slovakia has right to tax your employment income. Then there are other types of income, for example, royalties. And in any case, you have to, if you consider any income which you receive as a non-resident, you have to go to the tax treaty between Slovakia and particular country and check what is the relevant provisions of the tax treaty. For example, royalties, which if you receive some author's right for some work which you created in the past and you receive some license fees, for example, these are royalties as an example. This is passive income, and most of treaties cover this income in Article 12. So, for example, if you are a Slovak tax non-resident, receiving such income from Slovak entity, the Slovak tax law defines that the payer of this license fee can deduct 19% withholding tax on this income. But most of tax treaties, there is a link to particular treaties, have some provisions that based on which if there is tax treaty between Slovakia and this country, this withholding tax is reduced to 10 or to 0 even. Then employment income. We discussed that there are three conditions under which employment income may be taxed in Slovakia, but there is also, so if you receive income from Slovak employer or if you spend more than 183 days in Slovakia, your employment income may be taxed in Slovakia, but not full, but only a portion of employment income which is attributable to work physically performed in Slovakia. So even if we will come back in case studies to this, because in particular when you may have income from Slovak company, but you can you can be non-resident, have income from Slovak company, but you can work in home office regime from abroad. And in such case, for example, this income cannot be taxed in Slovakia or should not be taxed in Slovakia. We will go to details in case studies. Other example, member of boards of directors of member of supervisory board, if they are paid by Slovak company, they are always taxed. This income is always taxable in Slovakia. A business income, if you have some Slovak business license, this income is taxable in Slovakia. If you have foreign business license, this income is taxable in and you provide some services in Slovakia. This income is taxable in Slovakia only if you create permanent establishment in Slovakia. And now the most relevant point for our cases will be Articles 20 and 21 of the tax treaties, which deal with Article 20 deals usually with students. Article 21 teachers, lectors, and scientists. However, as I said, the Model Tax Treaty defines only Article 20, students, which gives some model provision for tax treaties, which Slovakia usually follows. And there is definition for that this OECD tax. This is not this is like model tax treaty. This is not provision from particular treaty. This provisions for students defines that if there is a student or trainee who is before visiting another state residing in first state, coming to back state to other state solely for education or training, he should not or she should not be taxed in the host country, and there is and other conditions, the source of such income is outside the host state. But this is provision from the Model Tax Treaty. As I said, the Model Tax Treaty is one document, and there is commentary to the Model Tax Treaty, which explains how particular provisions of the treaties should be applied in practice. Because the treaty is relatively short, there may arise many practical situation cases which are not directly explained in the treaty. Therefore, there is document called a commentary to the OECD Model Tax Treaty, and there is explanation to each article with some practical cases, and this commentary is regularly updated. The last update was in February 2026. No, it was November 25, sorry, November 25. And the last update, for example, was concerning cross-border home office regime of employees. So as you see, the commentary reflects to what are the trends in real life, and tries to answer also these new situations. So basically, this commentary to Article 20 says basically that it applies not to salaries, but it applies mainly to scholarship. It does not therefore apply to payment or any part before, that is remuneration, but it is for main, it applies, now we are talking about students only. It applies for payments for maintenance, education or training, and should not exceed the level or expenses that are likely to be incurred to ensure the recipient's maintenance, education or training. So it applies mainly on the scholarship, which is not remuneration, but it is some fee to cover expenses in the other country. And now it's like, as you can see, there is Article 20 in the OECD Model Tax Treaty. On the other hand, and there is no any provision in the OECD Tax Treaty concerning teachers, scientists, researchers, professors. So, but the countries in their bilateral treaties, many countries, they included special provisions also for these professions or for these individuals. As you see, there are some countries, Czech Republic, Denmark, Estonia, Finland, etc. These are just examples which have only provision about students. They have no provisions, specific provisions about teachers or scientists. On the other hand, some countries, when negotiating bilateral treaties with Slovakia, they included special provisions for these professions. And some countries included them in Article 20. Some countries, when negotiating bilateral treaties with Slovakia, they included new article for professors, teachers, or researchers. But again, as this is not based on some model treaty, it was always negotiated very individually. So each tax treaty between Slovakia and relevant country always may have different provisions for professors, teachers, researchers, or scientists. So it is very important that as this is not really harmonized, it is very important always to consider which is relevant treaty between Slovakia and relevant country and check specific provisions of particular treaty. There are some examples. For example, tax treaty with Germany says that university and other teachers, so it does not, for example, cover scientists, but does it cover scientists? Even some, yeah, there is research mentioned. Yeah, it does not say scientists, but it mentions research. If they are in another country for 2 years at recognized university, college, or other similar institutions, not intended for profit. So if there is intention, if they are commercial institutions, this provisions does not apply. Shall not be subject to tax in other country, like if provided that such remuneration is derived from places outside that other state. Very similar is the treaty with Poland, but there are quite often some small differences regarding uh, who whether these provisions what persons are covered by this provision. Sometimes there is this 2 years period. Sometimes there is no 2 years period for exemption of this income. So as I said, in each situation, each case must be considered individually. Uh, Based on we will return to this in the section of case studies. We will show again some more tax treaties, and maybe I will show also an example when there is different regime between two different treaties, different conclusion. Uh, Another point is if we find out based on the tax treaty that some income is taxable in Slovakia, meaning it is subject to tax and is not exempt from tax, there we can also consider provisions of the Slovak Income Taxes Act, and the most relevant provision for students is tax exemption for scholarship, which this income scholarship is exempt from tax in Slovakia. And if it is exempt from tax, it is exempt also from Social Security and health insurance. But there are some quite strict conditions. It must be provided from abroad to student. It must be by specific institutions, and it cannot be connected with performance or activities which generate employment income or business income. So it really should be scholarship covering the expenses related to stay in Slovakia. So this was the situation of Slovak tax non-residents. These Slovak tax non-residents, to summarize, are taxable in the Slovak source income only. Slovak source income must be considered. What is Slovak source income must be considered based on type of income, and each type of income then should be considered based on relevant tax treaty, whether it is taxable in whether Slovakia has right to tax this income or not. And if Slovakia has a right to tax this income, it must be considered whether in Slovakia such income could be exempt from tax. So this is basic logic for non-residents, how to determine their Slovak taxation, the scope of income which must be taxed in Slovakia. On the other hand, if the individual defines in this tax residency determination process that he or she must be regarded as Slovak tax resident based on the Slovak tax law and the tax treaty, such individual, you will be taxable in Slovakia on your worldwide income. As I mentioned, you can confirm this residency position via tax residency certificate. There is a link. If you will need such certificate, there is a link to the web page of the Slovak Financial Directorate when you can find out the request form for these certificates. Now, if you conclude you are Slovak tax resident based on the Slovak tax law and the relevant tax treaty, you are liable to tax in Slovakia on your worldwide income. However, what will happen if this income, for example, you are Slovak citizen and your family is here in Slovakia, but you you are employed for temporarily in other country, and you find out that in uh, this country applies taxation on this income. And already the treaties are called double tax treaties, and the main purpose of these tax treaties is to eliminate double taxation of any income. So basically, there should not be any situation that if there is a treaty that your income would be taxable in both countries. And there are two methods how to eliminate double taxation if you are Slovak tax resident. So if you are Slovak tax resident and you find out you have to declare the worldwide income in Slovakia, but if you find out that any part of your income can be or is taxed also in another country, there are two methods how to avoid taxation of this income in Slovakia. First method is tax exemption method, which says, and these methods are defined usually in Article 23 of every treaty. And if the treaty says that you can apply tax exemption method, it means that you declare worldwide income in Slovakia. However, if this income was already taxed in another country, you can exempt it from taxation in Slovakia. So you declare 100, but 20 was taxed already in other country. So you exempt this 20 and effectively you tax only remaining 80. This is exemption method. In most treaties, however, define that double taxation can be avoided via credit method. It means that if you paid already tax in another country, you have to declare this income in Slovakia as well because you are tax resident. You calculate Slovak tax from this income. However, you can credit the foreign tax against the Slovak tax up to the amount of the Slovak tax. For example, your income is 100, Slovak tax is 19, let's say example, but you paid already tax 30 in that other country. So you declare in your tax return income is 100, Slovak tax is 19, but because you already paid tax from this income in another country, amount of 30, you can credit this foreign tax against Slovak tax liability, but only up to the amount of the Slovak tax. So you can credit 19. So this is tax credit method. Good. So basically, this was the theory. I suggest that we go now to case studies, and after case studies, because after case studies, we can go to your questions, which if you drafted some questions, or if you have some questions, I see the 4 questions maybe. But let's go to case studies because maybe some topics which were discussed so far in theory will be more clear when we show them in practice. So, one quite often question coming is what we discuss about tax residency. How to deal with the tax residency when some individuals relocate to Slovakia or outside Slovakia during the year. For example, a UK employee relocates from the UK to Slovakia since 1st July together with the family, and he terminates UK tax residency as of end of June. I'm not UK tax residency rules are very, very, very complex, but let's simplify it this way. That in practice, that means that if you are not from UK does not apply calendar year as a tax period, but they have tax period from 6th April to 5th April. So in this particular case, this individual will be a UK tax resident based on UK tax law. until the end of June. But since 1st July, this guy, this individual will not anymore be regarded as tax resident in UK, but he will, or she will be regarded as tax resident in Slovakia due to permanent flat or due to 183 days will not be met, and because it's UK, also, there will be only temporary residency, so no permanent residency. But this person will have some house flat rented in Slovakia, so this person will be considered tax resident in Slovakia. And that means that in this particular case, this person for the first half of the year will be residing in UK. For the second half of the year, it will be residing in Slovakia, which gives also to this person some potential options for tax planning. For example, if in UK there are taxation of dividends 35%, so why not to wait for dividends till July, and in Slovakia, taxation of dividends is 7%. So with this tax residency, there are some options for the tax optimization. Okay, let's go to students. Like example, Czech student relocates from Czech Republic to Slovakia to continue where he continues post-graduation studies at the Slovak university. This person is single, parents remain in Czech Republic, this person rents flat in Slovakia. How to define tax residency? First, we go to Slovak tax legislation because it is Czech student. If he should go to Slovakia to foreign police to apply for residency permit. So this person should have permanent residency in Slovakia. But even if he does not request permanent residency in Slovakia because we are in the EU, still he likely has some permanent flat in Slovakia, which it might be flat, it might be room in this student's accommodation house, whatever, it is permanent flat. In Czech tax, based on Czech tax law, this person is still regarded as Czech tax resident because of permanent flat in a family house, let's say. So if this person now has to define what is my tax residency country, and we go to the tax treaty says permanent flat. Permanent flat, this person likely has in both countries. So this person goes to a second criteria, which is center of vital interest. And now this person considers, okay, to which country are my private ties closer? My family lives in Czech Republic, okay, but I have girlfriend in Slovakia, and because of that, I spend most of weekends in Slovakia. I shifted my bank accounts. I really feel I am here for 5 years, maybe, or also this period. If this person is here for 1 year, it is easy to argue that okay, during 1 year, the center of vital interest is not shifted to Slovakia. But if this person is here for 3-4 years, okay, then there are strong arguments that also the center of vital interest is shifted to Slovakia. There is no any official guide. For example, in Germany, they have if it is more than 2 years, there is likely that center of vital interest is shifted. If it is less than 2 years, mostly the center of vital interest is not shifted. But it's mainly about how this person finds argument and proof in the case of tax audit that these arguments are really valid. Uh, okay, another example. Employee of the Slovak University, like teacher, let's say, is assigned for 2 years to German university to teach there while he is remunerated from EU sources. It could be remuneration coming from German institution, but at the end of the day, it is funded by EU sources. permanent flat and fa- uh, and family remains in Slovakia. So in this case, this person will be regarded as tax resident in Slovakia. And because now, again, first step is to what type of income this person receives, and there is a special provision in the German tax treaty saying that the university and other teachers residing in one contracted uh, who are residents of a contracting states or were residents of contracted states before going to other contracted states. It means he is or was tax resident in Slovakia to pursue studies or research or to teach for a period not exceeding 2 years. So if he is 2 years to Germany, is assigned or has a local contract for 2 years at recognized university. So it is also important where is he assigned. Profit shall not be subject to tax in that other state, provided that such remuneration is derived from places outside that other state. So in this particular case, Germany is not entitled to tax this income, and this individual should tax this income which he receives from German university in Slovakia. I requested in this case the Slovak Financial Directorate for opinion about if this guy is remunerated by German university, but German university, it was not, it was when I requested it was Slovenia. So I put the Slovenia because I specifically asked about it was Slovenian case. And I received a response from the Slovak Financial Authority Directorate that if these costs are paid by Slovenian or German university, but they are reimbursed from EU sources in advance or subsequently, they should not be considered as payments whose source is in the territory of Slovenia, was the particular case. So therefore, also there was conclusions in previous case that even if this guy was remunerated, this teacher, university teacher, was remunerated by German university, but these sources of remuneration were from EU funds. For tax purposes, they should not be considered as sources as German sources, and therefore this exemption can apply, and the income of this Slovak resident, Slovak teacher, should not be taxed in Germany and should be taxed only in Slovakia. But there must be met all these conditions. One of them is 2 years assignment. If he was assigned for another year, this exemption would not be applicable anymore. Okay, let's go to another case. Non-Slovak individual residing in Italy is employed by Italian university, but this guy concludes local agreement. It can be employment contract, it can be dohoda, it can be like short-term agreement for part-time position, and he conclude such agreement with Slovak university and receives salary from the Slovak university, Slovak employer, for work performed in Slovakia. This first we go to this guy must define tax residency. Based on Slovak tax law, he may be tax resident in Slovakia, but the treaty will be clear because he's residing in Italy, the family is in Italy. It is only short part-time job for short term in Slovakia. It's quite clear that this income this individual will be tax resident in Slovakia, but because this individual received salary from Slovak employer for work performed in Slovakia, if this is employment income, this income may be taxed in Slovakia. But in the tax treaty between Slovakia and Italy, we find out that there is Article 21 saying that professors or teachers who are temporarily present in the contracting state for a period not exceeding 2 years. So these conditions are met. Carrying out research at university, college, school, which is not operated for profit, and who are or were resident of the other contracting state of Italy shall be exempt in Slovakia from taxations on remunerations for such teaching or research. So that means that in this particular case, Slovakia has not right to tax this income, and when the Slovak university pays this income, uh, it cannot tax this income in Slovakia, which is the good news. The bad news for the university is, however, these rules are likely not applicable in the area of social security. And if there is Slovak um, employer who employs a person who is in the Italian social security system, in such a case, there arise obligations for Slovak employer to register for social security in Italy. So no tax in Slovakia because this income is exempt from Slovakia, but as this person falls into social security system in Italy, the Slovak employer will be obliged to register in Italy. The very same case, but we have no Italian resident, but we have Czech tax resident who is employed by Czech university, concludes local agreement with Slovak university for part-time position, and this lady receives salary from the Slovak employer, Slovak university. Again, tax residency is clear. This permanent flat and central vital interest remains in Czech Republic, but the treaty is different. The Czech treaty does not have any special provisions for teachers and or scientists. So it means that in this case, as there is no special provisions, we have to follow rules for employment. Article 14 of the tax treaty between Czech Republic and Slovakia. Article 14 says that if there is a non-resident, but he receives remuneration, employment remuneration from Slovak employer and for work which is performed physically in Slovakia, such income is taxable in Slovakia. So we have no any provisions exempting this income from taxation in Slovakia, and the Slovak university must withhold Slovak taxes from this income. And then after the end of the year, the Czech employee, is obliged to perform some annual tax reconciliation in the form of tax return or annual tax reconciliation. For completeness, Social Security has the same regime. This person is falls into Czech Republic Social Security system. So any employment income is subject to Czech Social Security. And in order to pay Czech Social Security, the Slovak university has no choice just to register for Social Security in the Czech Republic. Okay, let's not go to detail as regards Social Security. Another case, Indian scientists, now we are outside the EU. In Slovakia, Indian student is undertaking postgraduate studies in Slovakia. He holds a Slovak residency permit and resides in Slovakia. He has employment contract with Hungarian Slovak universities from which he receives remuneration. So Indian student in Europe, some part-time contracts in Hungary and Slovakia. Question one is Social Security, because Slovakia does not have a Social Security agreement with India, but based on the EU regulation, the legislation applies also on non-EU citizens if they reside in Slovakia. So yes, now we so the EU legislation is applicable on this person, and based on this EU regulation, it must be defined whether this person resides in Slovakia or in Hungary in this particular case. As regards taxation, we we would have to define domestic legislation, tax residency position based on Slovak tax law and tax treaty between Slovakia, and we have now two countries, other countries concerned. If this guy is Slovak tax resident, he would be taxable in Slovakia on worldwide income. And based on tax treaty with Slovak tax legislation says that if there is employment income, the individual can use tax exemption method irrespective of the provisions of the treaty, meaning that if this guy is Slovak tax resident, he must declare worldwide income in Slovakia. But if this income was taxed in other country, Hungary or India, he can exempt this income from taxation in Slovakia. So this is in the case of tax resident. If he is tax resident, if he is non-resident, we have to this individual will be taxable only on Slovak source income. The Slovak source income we have to define what type of income is it? Is it employment income, or is it income of a teacher or a student? And now now we have to consider in which country this individual will be regarded as resident. So we have no enough information. I put there two options. If this individual resides in India, that he has family in India, he works here in Slovakia, Hungary, but he still has a center of vital interest and permanent flat in India. We follow tax treaty between Slovakia and India. If this guy is a Hungarian resident because he relocated to Hungary, his center of vital interest parent flat is in Hungary, he must follow the tax treaty between Slovakia and Hungary. And you can see, like for example, that in case of Hungary, I think if I'm right, there is no this limit of 2 years, which is, for example, in India, with the tax treaty between India and Slovakia, the provisions for professors and teachers, there is limit for exemption of 2 years. With tax treaty between Slovakia and Hungary, there is no such limit of 2 years for exemption. Another exemption, royalty payments. Slovak tax resident received royalty payment from Swiss entity. He is tax resident in Slovakia. So this guy has a royalty, let's say some license fee. Yeah? He created something and has some in Slovakia with the Slovak tax law differentiates active author's right for creation of something and passive authorized royalty which is fee for some license. And so this guy, if he is Slovak tax resident, such income from author's right must be taxed in Slovakia. And to avoid double taxation, if there is Swiss tax applied, it can be credited in the Slovak tax return. So to avoid double taxation. Reverse situation, Indian tax resident receives royalty payment from a Slovak entity. So again, it's passive income, which Slovak tax non-resident receives from a Slovak entity. Because the Slovak tax law says Slovakia can tax this income by 19%. The tax treaty between Slovakia and India says the source country, Slovakia, can apply the withholding tax maximally 30%. So in practice, the Slovak company, the Slovak paying this income, the Slovak entity paying this license fee to Indian tax resident will apply 19% Slovak tax. And then in India, this Indian tax resident can credit this tax in India. Uh, and I think the last cases concern cross-border home office, which is very hot topic these days. As I mentioned, in November 25, the OECD Model Tax Treaty was updated, and the main reason for the update was that especially to cover the situations of employees who work in the cross-border regimes, and there are questions mainly whether such activities create permanent establishment for the employers. So we have the situation when Slovak entity employs individuals who lives with family in Heinburg in Austria. The employers allowed employee to work 40% of time in home office regime in Austria. That means this employee is considered to be Austrian tax resident, but he has a Slovak employer. And there are very couple of questions, social security system that will be applicable, what is the risk of creation of the permanent establishment of Slovak employer in Austria, how the individual will be taxed in Austria, how the individual will be taxed in Slovakia. Uh, I will make one exception. I say we will not discuss social security, but in social security in year 2025, there was introduced new provision in the social security regulations within EU. So we will discuss very briefly how these teleworking conditions can be applied in social security scheme. Permanent establishment, we don't consider at this stage because in case of non-profit, permanent establishment is the situation when one employer performs activities or the company performs activities in other country. And if there is permanent establishment, the part of the profit should be allocated to this another country. But in the case of non-profit entities, the question of permanent establishment is not so much relevant. How the individual will be taxed in Austria. But first let's say how this individual will be taxed in Slovakia, because Slovak company, Slovak entity, Slovak employer will pay full remuneration, full salary to the employee. But as this employee is non-resident in Slovakia, and we said that non-residents are taxed only on Slovak source income, Slovak source income in the case of employees is income attributable to work physically performed in Slovakia. So in this case, if the Slovak company employs Austrian tax resident and this employee works 60% of time in Slovakia, 40% of time in Austria, only 60% of his salary will be taxable in Slovakia. Remaining 40, so the Slovak employer withholds Slovak tax prepayments only from 60% of remuneration. Very briefly, these special rules for Social Security, because there are two rules for Social Security. One is if employee works in two or more EU member states, he should fall into Social Security system of the country in which he resides if he performs more than 25% of activities in the residency country. So if we follow in this particular situation, in this particular case, if we follow basic rules defined by EU regulations, this individual will fall into Austrian social security system, and the Slovak employer should register in Austria for social security as an employer. This was the situation until 2025. In 2025, or maybe it was already 24, there was special teleworking rules introduced in Slovakia and in EU, which says that there is special provisions for teleworking rules if employee resides, let's put it in this practical case, if the employee resides in Austria, is employed by Slovak employer, performs work in Slovakia and Austria, perform work using information technology in order to maintain the employee's connections with the employer's work environment, and performs work from Austria in the scope 25 to 50%, employee can stay in Slovak social security system. So if there are teleworking rules and if this employee can work, in our case it was 40%, so if these conditions are met, in our particular case, the employee may stay in Slovak social security system and the Slovak employer is not obliged to register in Austria. But it is important to say that not all EU countries accept these rules, and this list of countries is not is flexible. But at the moment, 1, 2, 3, 4, 5, 6, 7, 8 countries from EU and EEA, and you see there is also Iceland, do not follow these rules and follow just the previous rules of 25%. Okay, and if this was rules for EU countries. If we go outside of the EU, then of course we have to follow bilateral agreements between Slovakia and particular countries. Okay, so these were the general rules, and now the practical topic is beginning of 2026. And you concluded you work in Slovakia or you are Slovak tax resident, or for whatever reason you are considering whether you have to file tax return in Slovakia or how to manage your Slovak taxation. So there are some general rules at the beginning. If you have even if you have Slovak employer, tax prepayments withheld by employer are not regarded as final tax in Slovakia. So you cannot say that it is always obligation of the individual to arrange the reconciliation on the annual basis. And there are two options in the case of employment income, how to arrange this annual reconciliation. There must be one of these two options. First option is to request employer for the annual tax reconciliation, but the individual, the employee, must meet some conditions if he wants to request employer. First, he has only employment income taxable in Slovakia. Second conditions, there is no foreign source income received, and this employee must request the employer for the annual tax reconciliation by 15th of February of the following year. If these three conditions are met, the employee can ask employer, please arrange my annual reconciliation on my behalf, and the employee will receive just final confirmation that employer performed this annual reconciliation, there is overpayment or underpayment, and this will be reconciled by the employer in the next salary of the employee. If the employee does not meet conditions or did not request employer for annual tax reconciliation, the employee is obliged to file tax return in Slovakia. What is important limit? The individual is obliged to file tax return for year 2025 if his or her total taxable income exceeds amount of 2,876.90 euro. This is a threshold of taxable income. If individual receives taxable income above this limit, there is obligations to file tax return or request annual tax reconciliation. Taxable income means any income that is subject to tax and is not exempt from income and was not taxed by withholding Slovak tax. So everybody who's if it is resident, worldwide income, if it is non-resident and is Slovak source income, if such income exceeds this limit, there is obligations to file tax return. If in the case of resident of Slovakia, total taxable income includes also income from abroad, like total worldwide income. Deadline for tax return filing was end of March, but there is option in the Slovak tax law that a taxpayer can extend income till end of June. There are without any conditions, and there is option also to extend the filing deadline to end of September 26, but only if in the tax return there is reported also foreign source income. So there are one standard deadline and option to go for extension. If it is already too late to apply for extension because it must have been filed this extension announcement till end of March. But for the next years, you can remember that there is such option. And if you want to extend your filing deadline, you have to provide it to the tax authorities on official document, which is available on the webpage of Financial Directorate. You can find it here, the link to this document. What is also important to say, if you extend the filing deadline, you extend also the deadline for the payment of taxes. So it is really recommended if you know that there will be tax to be paid for resulting from your tax return, it is recommended that you extend the filing deadline till June at least, and in that way you can pay the taxes also 3 months later comparing to official deadline. When you want to file tax return in Slovakia, you have two versions of tax return, two tax return forms. Tax return form type A is used by taxpayers who receives only employment income. If some taxpayer, in the individual taxpayer, receives also some other income than employment, meaning business and rental income, this is section 6 of the Slovak tax law. Capital income like interest, redemption of mutual funds, or maturity of bonds. This is capital income, section 7, or other income like capital gains from securities, from crypto, or from the sale of immovables. Such income is reported in section 8. And if there is any or there is missing dividend, which is section 3, if dividend from abroad, if individual taxpayer receives such income, he or she must file tax return type B, not type A. And I strongly recommend if you decide that you want to file tax return on your own, to use the e-forms which are available on the website of Finančná správa SK. We will in few minutes we will go and we will fill in one example tax return type A, so you can see how in practice to fill in. Oh, for 2025, there were quite many tax rates in Slovakia. We had time in Slovakia when we have only one single tax rate, 19%, but recently we have many tax rates. For 2025, employment and income, business income, rental income, and capital gains were subject to uh, one tax base and were taxed by 19 and 25%. Up to 48,000, the tax rate was 19. Amount income above or tax base above 48,000 euros was subject to tax 25%. Because governments needs more money since 2026, they introduced two new tax rates, 30 and 35%. So if somebody earns more than 75k euro, this part of the tax base will be taxed already by 35%. And then we have some other tax rates, flat rate of 19% on capital income for individual entrepreneurs with revenue up to 100k. There is flat tax rate of 15%. And on dividends, we have two rates depending when the profit was created, and there are two rates of 7 and 10%. Uh, when we define taxable income, this covers all income which is subject to tax in Slovakia and is not exempt from tax. There are two examples of income which are exempt from tax in Slovakia based on Slovak tax law. We already mentioned scholarship income covering just real expenses, not remuneration, is exempt from taxation in Slovakia if it is paid by specific institution. And also, if individual receives capital gains from the sale of securities listed on regulated stock markets and holds these stocks, these securities more than 12 months, the capital gain is exempt from taxation. Recently, there was introduced also some exemption, for example, for startups. If individual receives some share in startups, such income up on some conditions may be exempt from taxation in Slovakia. I think it may be relevant for scientists and students. This startup startup exemption. Then there are rules. If someone receives amounts in foreign currency other than euro, how to recalculate these amounts to euros, because all numbers reported in Slovak tax returns must be reported in euros only. And if we are talking about individuals, they have they have option to choose one of the four exchange rates for their income received in 2025. Either the simple way is to apply average exchange rate for 2025. These exchange rates are published at the web page of the National Bank of Slovakia, nba.sk. You can find their average rate for 25, or the individual can use average exchange rate for months in which she received taxable income, or average exchange rate for particular months in which the taxpayer received the income, or the the individual may use the exchange rate as of valid at the day of receipt of the income. So again, because now there are quite these exchange rates in 2025 were quite up and down. So if there are significant amounts, for example, of income, for example, in US dollars, it may be tax effective. There might be some tax optimization if you choose like proper exchange rate. Uh, then, when the individual files the tax return and she receives active income from employment or from business, there is option to apply some tax deductions or tax credits. First, potential deduction is general tax allowance, which is applicable for every individual. The maximum amount of general allowance is deduction. So it is when you calculate your tax base is employment. In the case of employment, tax base is employment minus social security contributions, and there may be applied further deductions of the general tax allowance, which is for 2025 5,753 euros. But if employees' tax base exceeded 25,426 euros, this general tax allowance is decreasing. And if the employee's tax base exceeded 48,000, then the tax allowance is zero. So this is general tax allowance. Then there is spousal tax allowance on husband or on wife, which can be applied, but it can be applied only if the employee meets some conditions. It means that the spouse takes care about child with age of 3 years or less, or the spouse is unemployed or disabled, and as well, the amount of the spousal allowance depends on the income of the taxpayer and the income of the spouse. So quite important restrictions. And the last deductions, which is defined by the Slovak tax law, is deduction of the contributions to the supplementary pension scheme, but the amount of deductions is limited to 180 euros. These were deductions. The other type of tax benefits are tax credits. Tax credits are decreasing not the tax base, but the final tax already. So when you calculate your tax, you decrease the final amount of tax by the child credit if you meet some conditions. Child bonus in 2025 applies only on children with age less than 18 years. Before 2025, it was the limit was 26 years. So the child bonus was applicable also on children who studied on universities and were still dependent children. But since 2025, the tax credit is applicable only on children with age below 18 years. And the amount is 100 euro per month for children with age up to 15, and for children up between 15 and 18 years, the amount of child bonus is 50 euros per month. And the other bonus is mortgage tax bonus, mortgage interest tax bonus, which applies on interest on Slovak mortgages taken by taxpayers at the age below 33 years, with some income limitation in the year when they took the mortgage. So it applies basically only on Slovak mortgages, and if you meet these conditions, you should get confirmation from the bank that you can apply. What is very important in the case of international taxation? If the taxpayer individual is non-resident in Slovakia, he or she can apply these deductions and credits only if he or she declares more than 90% of worldwide income is effectively taxed in Slovakia. So if somebody is non-resident and the majority of income is taxed outside Slovakia, uh, the, he or she can apply only general tax allowance, but not other tax deductions or tax credit. And since 2025, there is restriction also for tax residents who want to apply to child bonus. Uh, Also, these residents can apply child bonus only if they effectively tax more than 90% of worldwide income in Slovakia. So we had examples of Slovak residents who works in a Czech Republic, but still is Slovak tax resident. But if he taxes more than 10% of his income in Czech Republic and effectively less than 90% of his or her income is taxed in Slovakia, no child credit can be applied. Okay, and last part is how to complete and file your tax return. Practical example. You can see when you receive this presentation, you can see relevant provisions, but I suggest that I go back to this electronic form. Uh, and it doesn't work. Yeah, can you see? I can you see now?
Yes, we can see.
You can see this form. If you click on this, as I said, if you want to do tax returns by yourself, I always recommend using accountant or tax advisor, but if you want to do it by yourself, I strongly recommend to go to this official webpage of Tax Directorate and fill in the tax return on this page, and we can go through simple tax return type A, meaning type A is tax return in which you declare only employment income. So you, at the beginning, you see always this little red star if it is a mandatory question. So you have to declare whether it is standard tax return, corrective, or supplementary tax return. Now still we are likely filing standard tax return. You fill in tax ID number. If you are Slovak residents, or if you have permanent residency in Slovakia, or even if you have temporary residency on your card, you have birth number, so you can type it here. If you don't have residency permit in Slovakia, you type date of birth. So I put some example. The system indicates that this is not valid, but okay, let's skip it at this stage. Then in first section, you have to declare your private data. Surname, name, it asks you about title. I strongly recommend to give also titles because the ladies at tax authorities have quite respect to titles. Then you fill in a permanent address in Slovakia or abroad. This is important for one reason. If you are Slovak and you have permanent address in Slovakia, your tax return will be processed by the authority depending on your permanent residency. So if you have permanent residency in Košice, the tax return will go to tax authority in Košice. If you have a permanent address in Bratislava, your tax return will be processed in Bratislava. So here you declare your street, and if you put there foreign address, it will be processed by the tax authority Bratislava. So if you don't have permanent residency in Slovakia, you declare here street number, uh, orientation number, city, and country. And you see what is quite helpful. If if I put here some, if the system misses some data, it will indicate in yellow. If the system misses some critical data, it will be shown in red. Then there is question whether you have to click if you are tax non-resident in Slovakia based on what we discussed. If you are non-resident, it asks you also for what period you are non-resident in Slovakia. And it asks you about tax identification number in your residency country. So if you are non-resident in Slovakia, you have to click here. I am non-resident. I am non-resident in this particular period. And in my residency country, yeah, my tax identification number is this and this. It will help you then when you request Slovak authorities for tax certificate, because you may use it in your residency country. They need this information to provide this certificate later to you. This we can skip. These are representative, so this is not relevant for you. In section 3 of the tax return, there is question whether you are receiving pension at the beginning of 2025, because if you were receiving pension, you would not be entitled to general tax deduction. So you click only if you received this old pension. You go further. Line 29 is applicable only if you want to apply spousal tax allowance. What I said, if you are non-resident, it's almost not possible because you would have to declare 90% or more of income in Slovakia. If you are a resident, you can be entitled under these conditions that the spouse is taking care about child, or is unemployed, or is disabled. You can apply spousal allowance if you want. You have to declare name of the spouse, birth number of the spouse, income of the spouse, a number of months for which you are entitled. You go further to line 31 when you declare that you applied child bonus on children. And if you again meet conditions for child bonus, you put surname and name of the child. Very important is to put birth number of the child and number of months during which you are entitled for the child bonus, which is usually full year. But for example, if the child was born in 2025, you can apply child bonus only since the month in which the child was born. If the child exceeded 18 years during 25, you can apply it only until the month in which the child reached the age of 18 years. Article 32 we can skip. It applies its specific provisions. Section 4, it's a tax credit on the mortgage interest. If you want to apply this, you would need confirmation from a Slovak bank, and basically you just fill in data from this confirmation. And here, Article 5 is the relevant one. It's a article in which you declare your employment income which you received from. And now it's question: if you are Slovak resident, you declare worldwide employment income. from Slovak employer, from foreign employers. If you are non-resident, you declare only income from employer taxable in Slovakia, which is related to your Slovak working days. So I now switch, delete that I'm non-resident. So I will now file tax return as a Slovak tax resident. So I take my income confirmation from Slovak employer, I take my income confirmation from foreign employer, and my total employment income was, let's say, 30,000 for 2025. Then what I can deduct from the tax base amount of Social Security and health insurance. So from this 30,000, let's say I paid, it's 9.4%, 2,800 euro Social Security, 4% is, and 1,200 health insurance. You see always there is something yellow, so something is missing there. So I make a double click and the system calculates the proper figure which should be in this line. Again, here is tax base. Tax base is amount of income minus amount of Social Security and health insurance. I either can calculate manually or I make double click and the system calculates the proper amount itself. So I see now that my tax base for 2025 is 26,000. Here is tax deduction, this general tax deduction, which depends on the amount of the tax base. Again, you don't have to calculate, you just make double click and the system calculates what amount of tax deduction you can apply. If you put some information about spouse, her name, her birth date, her income, the system would also calculate spousal deductions if you are entitled. And here is this deduction on supplementary contribution to supplementary pension fund, but it is limited to 180. So if you put different amount, the system says no, it's wrong. You can apply maximally 180. So total amount of tax deductions, again, it's calculated automatically. And the system here shows you that, okay, I miss information in this line. Here, line 45 is your final Slovak tax before tax credits. Again, you don't have to calculate manually, the system calculates for you. Okay, now you are coming to line 48. Line 48 is tax base related to income taxable abroad. So in this case, my total income was 30,000. But as we discussed, I had also foreign employer and 10,000 euros less some social security and health insurance I taxed in another country. So this to avoid double taxation, because it was 10,500 was related social security. So I exempt this income from taxation in Slovakia because this income was already taxed abroad. So I put it here, and this is my tax base after exemption. And in line 50 is my Slovak tax liability after exemption of income, which was taxed in another country. All this is calculated automatically. You have option also to apply a credit of employment income, but based on my practical experience, it never makes sense. It is here for completeness, but it never makes sense to apply credit in the case of employment income. You can always use exemption method. And you just go down and you just see, okay, the system is missing some information in line 56. It's tax after credit. Here, if this lines 56A and 57 is child bonus if you are entitled, and if you put some information about children, the system would calculate what amount of child bonus you are entitled to. I didn't put any child, so I leave it empty. I go like final tax after tax credits, and then uh, I see, okay, this was yellow, I put it here. And then you go to line 69. In 69, you declare amount of tax prepayments which were withheld by the employer during the year. Because in your income confirmation, you see that on a monthly basis, your employer did some deduction of tax prepayment. And so you paid already some advanced taxes, and you declare these advanced taxes here in this line because these were already withheld from your salary. So you from it's line 4 in the income confirmation. If you have Slovak employer, he gives you at the end of the year income confirmation. In line 4 of the income confirmation is the amount of the tax which the employer already deducted from your salary during the year. And here you see that in this case, my tax was 2000, but employer deducted during the year already 3000. So I should get a fund of 965 euros, which will be refunded to me within 40 days after the tax return filing deadline. So this is brief. This you can now you see like the final result resulting from your tax return. Section 7 you skip. It's if you file supplementary tax return. You go to section 8, which is optional provision. In Slovakia, you have options to donate 2% of your liability to a non-profit organization. So if you want to ignore, if you don't want to contribute donate anything to non-profit organization, you skip. You click I don't apply. If you decide, okay, I want to give to some charity, you put ID number of this charity, you put name of the charity, and you put here, you click here. What's wrong? Here, the amount. You will not pay anything. It is that 2% of your taxes will not go to government, but instead of the government, they will go to the charity you choose. And since 2025, there is a new option in the Slovak tax law. You can donate 2% not just to non-profit organization, but also you can donate to your parents. Rodné číslo. So, to parents, I want to donate to my mother 2%, so I fill her birth number, her name, and I know that 2%, this amount, will again not go to government, but will be donated to my mother. But you can donate this 2% only to your parents, and only in the case your parents receive pension from the Slovak scheme. This is if your parents are living or are receiving pension in other country, you cannot donate this 2%. You cannot donate this 2% to if you have spouse and spouse's parents are in Slovak system, it's not possible to donate. Only your parents and only if they are receiving Slovak pension. And this is almost last. This is section 9 is relevant if you were receiving, if you declare that you are a tax resident and you reported that you are exempting some income from taxation in Slovakia. And the system asks, in which country did you tax income? I did tax my income. Where is Czech Republic? Okay. In Croatia. And I taxed 10,000 in Croatia. 500 were related social security. So I declared in my tax return that I am exempting 9,500 of income because this income was taxed in Croatia. And I must declare in this section 9 that in which country it was and what was the amount of income and what was the amount of related health insurance and social security. If you are non-resident, the relevant section is Article 10, and the system asks you, okay, if you declared yourself to be non-resident, in which country you are tax resident based on the tax treaty. And the last information to be filled in the tax return. If you report tax overpayment, you click here. I want to refund the tax overpayment. You have option to receive it via post, or you receive it on the bank account. I don't know if somebody is still using these postal checks. Usually, if everybody has tax account, either Slovak or foreign, the Slovak authorities would refund overpayment also to non-Slovak tax return. And you declare, I want to refund my overpayment to this bank account. The system is quite clever. It tells you, okay, but this IBAN is not in correct form. And so I have filled on all relevant data in the tax return. And now I can see here, the system indicates there are some yellow lines, meaning these lines are not correct, likely not correct. The logic of the system expects some different information, and there are some red lines, like the system says, these are critical, and if this is red, it means that I will not be able to submit the tax return. Like the system says, okay, this tax ID number is invalid. You cannot file the tax return with this number. The system would not allow me to file electronically such tax return if there are such red critical mistakes. So this is briefly how to fill in the tax return. And let's go back to presentation. Can you see now the presentation?
Yes, we can see.
Okay, so it is here also. All these relevant lines are here, but I think it was better to show you in practice how the system works. If you want to do it really by yourself, I strongly recommend using this. Not from beginning. Okay, tax deductions and tax credits. Okay, signature. You have submission of the tax return. You have two options how to submit the tax return to the authorities. Option 1, electronically. But to file tax return electronically, you need electronic signature, and you have to create connection with the tax authority, or you can file tax return in paper form. If you want to file it in paper form, you fill in the tax return. You check out that you have no any yellow or red lines, that the tax return is controlled automatically. And it is important that you sign the tax return in all relevant places that where it must be signed. Because if there are some if there are some missing signature, the submission of tax return would be considered invalid. So this basic signature, if you file tax return type A, is page 6, section 9, or if you file tax return type B, page 13, section 11, and page 17. These are signatures that must be in the tax return, otherwise the submission is invalid. In the case of overpayment, there is additional signature that you want to refund the tax overpayment to the bank account that you declared. It's page 6, section 11, page 13, section 14, depending on tax return type A or B. And if you want to donate 2% to non-profit organization or to parents, one additional signature is required. This is signature. And the last step, if there is tax to be paid resulting from the tax return, you have to pay this tax return to the tax authorities by end of March or end of June, depending when is your tax return filing deadline. And every taxpayer in Slovakia has allocated the private taxpayer's personal account. It's called osobný účet daňovníka. So you always, as long as you have to pay taxes in Slovakia, you will pay it during whole your life to your private personal bank account, which was created by the tax authorities. And how you find out what is your taxpayer's personal account? There is a web page. If you put there your birth number or tax ID number, the system will show you your taxpayer's personal account number. And then you go to another page, and you put prefix, you put your taxpayer's personal account, and the system will generate to you your tax bank account number in IBAN format, to which you have to settle your tax resulting from the tax return. So in Slovakia, you don't wait for some tax assessment like in other countries, like in Austria or Germany. You file tax return and you wait for tax assessment. No, in Slovakia, when you file tax return, you make like self-assessment of taxes, and you have to pay the amount of taxes which you declared in your tax return. You don't wait for any assessment, payment instructions. No, you pay automatically when you have filed the tax return. And if you don't have taxpayer's personal account created yet because it's your first year in Slovakia, you just file tax return and you wait, and the tax authority will create taxpayer's personal account to you and will send you a notification via post that this is your taxpayer's personal number, and then you have 8 days after you receive this document to pay the tax to the Slovak authorities. So basically, yeah, this is how the Slovak compliance work, how you like transfer all this information about your residency, your income taxable in Slovakia, how to transfer it to like real Slovak tax declaration, which either, if you have extended tax return filing deadline, then you have time till end of June to prepare, to submit, and to pay these taxes to the Slovak authorities.